Cutting through the market noise, my name is Kamohelo Maishwani at Capital Link Partners.
Hi, I'm Simbitzen Goko, giving you a brief summary about the macro environment in the first quarter.
Hello, I'm Similo Dingile. This is a Capital Link Partners quarterly update. In our last quarter report, we spoke of three scenarios. Scenario number one, soft landing, which means inflation comes down with strong economic growth. Scenario number two, no landing, which means inflation remains elevated with strong economic growth. And scenario number three, which is recession, inflation comes down aggressively together with economic growth. In this report, we're going to provide an update on the three scenarios. The three scenarios focus on the path that inflation is going to take in the short term to medium term. Starting with equities, we believe that stock price performance is directly proportional to ratings change plus earnings growth. Under the three scenarios, under scenario one, we anticipate that inflation will come down with strong economic growth, therefore supporting equities from both the ratings change, because when inflation comes down together with interest rate, the stock prices will re-rate up, prices increase, while economic growth is going to support earnings growth going into the medium term. Under scenario two, which is no lending, inflation remains elevated with economic growth remaining elevated as well. Economic growth will support earnings growth, while inflation is going to keep the ratings depressed, meaning that net we expect positive returns from the equities in the short to medium term. Under scenario three, which is recession, we anticipate that the ratings change will provide support for equities in the medium term. In the short term, we expect equities to come off as earnings growth will come into question. But as interest rates come down, we anticipate that the re-rating up will provide support for equities. If I move to fixed income trade for the year is going to be a very tricky trade, because unlike equities, which has got several things going for it, fixed income is the performance of it will be predominantly be determined by the path that inflation will take. Under our three scenarios, we foresee different path that the yield curve will take to normalize, because we don't think the developed world inverted yield curve is the new normal. Currently, the short-term rates, if you look at 10 years minus 2 years, the 2-year rates are still higher than the 10-year rates, meaning the yield curve is inverted. We don't think that is the new normal. We anticipate that the long end of the yield curve will have higher rates than the short end. Therefore, there's going to be a change on the yield curve depending on the path that the inflation is going to take. Starting with scenario one. Under scenario one, interest rate comes down with elevated economic growth. Under that scenario, we anticipate that the entire yield curve is going to come down, shift lower, with the front end of the yield curve shifting a little bit more than the back end of the yield curve. And therefore, we anticipate under scenario one that this is going to be a year for fixed income. Fixed income is going to do very well. Under scenario two of no lending, inflation remains elevated. As a result, interest rates also remain elevated. We anticipate that the yield curve will steepen. The long end of the government bond yield will move higher than the short end, and therefore not very positive for fixed income in the short term. Under scenario three, recession, we anticipate that in the event that scenario three comes into fruition, it will be a result of scenario two being realized first, meaning inflation remains elevated a bit longer, meaning that the central banks will have to keep interest rates higher, may even have to increase interest rates to fight inflation, as they have frequently said. We think that is going to lead to a depression in economic growth, which may lead to scenario three, recession, and therefore interest rates come down aggressively, not in the short term, in the medium term. When interest rates come down aggressively, the short end of the yield curve is going to come down quite a lot. compared to the back end. In that scenario, recession or scenario 3 has got the best outcome for fixed income. Moving on into currencies, scenario 1 is negative for the dollar. We anticipate that as soft landing unfolds, that emerging market currencies will do better than developed market currencies. Under scenario 2, which is the worst scenario for emerging market currencies, we anticipate that the Japanese yen, the euro, the US dollar will remain strong, limiting liquidity in the developing world. And under recession, we anticipate if a recession comes through, that first there can be flight to safety, meaning that emerging market assets may come under pressure for short term. And as interest rates come down in the developed world, that difference in interest rates between developed markets and emerging markets will provide an incentive for investors to move assets to developing world fixed income assets. And therefore, over the medium term, the emerging market assets, including their currencies, may do well after the brief recession brought by the central banks. To conclude, we think right now where we are, our macroeconomic factors and models are showing us that soft landing is still very much on the cards. We are somewhere between soft landing and no landing, tilted towards soft landing. As the numbers come through, we don't see, even though the probabilities of a recession are still very high, market participants anticipate that the recession is still very possible. We don't see it yet, but we do anticipate that the probabilities will go higher if the inflation remains resilient, together with good economic growth. The risks that we are looking at in the global market is conflicts in the Middle East. We think there is risk there, especially if oil remains elevated. It might provide support for inflation to remain elevated for a little bit longer, meaning that scenario number 2, no lending, remains with us in the short term, and that's a risk to fixed income assets. The other risk is China. China has been very slow. I mean, economically, we think that it presents quite a risk to global assets. I mean, the government has often said that they're going to support it, they're going to do everything for the economy, but we don't think market participants really believe it, because I mean, the scales of the interventions they have spoken of has not been that good, to convince market participants that they're actually serious about turning that economy around. And the last part is that over the last year, 2023, we've seen bad market data. For example, a terrible employment number being good for the assets, equities, and fixed income, as that was taken as an indication that inflation may come off. We do start to worry, as the economy remains resilient, that these bad numbers may start to show that a recession is possible, which can start to depress the equity market, but they'll be bullish for fixed income.